Stocks sinking to start September, but there could be a positive surprise in store. So says CNBC contributor Tom Lee of Fundstrat Global Advisors, with me here at Post 9. You're always trying to find the positive within the negative. Some say it's getting harder to do that.
Yeah, I mean, the last few weeks, it's been hard to find anyone that is positive, right? I think they've all been gone into hibernation, early winter.
There are a few people, here and there.
Yeah.
But what allows you to remain as such?
Well, I think that it still comes down to our belief that a lot of the pessimism about inflation is anchoring negative sentiment. We know that this is also sort of part of the Fed's default view, and we're coming into September, which is a seasonally tough month. But in the past week, we've gotten some data that I think really shows inflation could be falling far faster than expected. One, gasoline. As we close out the month, it might subtract 0.6. The ISM prices collapsed for the month of August, and that really points to potentially PPI going to almost 0% in a few months. And then I think the third thing that's pretty encouraging is if you look at sort of the composition of CPI, 42% of the basket is actually now in outright deflation. So I would say I think there's still positive surprise coming, and it's the fact that inflation could cool a lot faster. And history shows once it starts breaking, it falls very quickly.
What if the surprise is that the Fed is more resolute than people want to believe? That, there's a bit of denial going on as to the Fed doing what Jay Powell suggests they will, and sticking with it, and keeping rates higher for longer, and keeping rates higher for a lot longer, and a lot higher than people think?
I'd say that that's the consensus view, and I think it's appropriate. The bond market still is not completely convinced, as you know, because the bond market is pricing Fed funds peaking next year and then some cuts coming. And if you look at the inflation swaps market, for the next 2 months, the inflation swaps market is forecasting deflation. So outright prices falling. So I think that it's possible in the next couple months, the idea that inflation's sticky and the Fed has to therefore stay tough is going to be modified by the idea that inflation could be coming down very quickly.
So what do I do with the other risks? Because September seems fraught with them. We get a great reminder today, an awful reminder, but a big reminder of that with the pipeline. I've got the potential for earnings revisions. I have the Fed meeting. I've got the dollar, which remains especially strong. I've got oil still hanging around 100 with the propensity perhaps of going higher. None of that matters?
No, they all matter. But I think markets need some perspective. In June, people talked about gasoline going to $6 or $7 because people forecast oil going to 180. Now we're in September and oil's at 86. The concerns about Europe, they're still there. But as you know, just a few months ago, people were forecasting much greater shortages, and it looks like Europe's made some progress filling up. And I would say just from a market history, I know seasonality is tough, but we already know investor positioning is actually really light and sentiment's negative. So I think as technicals improve, the dollar doesn't have to keep going up. And if interest rates break, I think a lot of these could add up to stocks rallying pretty hard.
What multiple is justified, do you think, for the market?
I think the best way to still judge the PE is to look at the 10-year. And the 10-year, if it's at 3.2, is still a roughly 35 PE market. I don't know why we would say the S&P has to go to 15 times. Again, I think if the 10-year drifts back down to 2.7, you're talking a 40 PE for the 10-year. I'm not sure why the S&P PE has to go to 15 times.
Okay.